Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really excited to have you today. We've got a lot to talk about, actually. This show is designed to kind of answer questions about, kind of what's going on in the markets, what's happening, in terms of retirement planning and what have you. We do that by answering your questions. Some of these questions we get from, the emails that are coming in, the strategy sessions that we have, or you can ask those questions now if you want. You can send them in to two ways. One through the email here, ask Tom at talkmoneywithtom.com. Or if you're signed into the YouTube channel here, you can put it into the chat. So love to answer your questions. Go ahead and start sending those in. Send them in during the week if you like, whatever comes up. And so altogether, the channel here is designed as a resource to kind of push education along, how to become a better investor. Because, in my experience, even somebody who has an advisor like us, the more that they know, the better that they can communicate with their advisor. The easier it is for their advisor to communicate with them. The easier it is to kind of stay in these bad markets when they should, maybe get out when they should, whatever it might be the situation. And so you can subscribe to this channel, continue your education, hit the bell button, go look through some of the videos. Got a couple thousand on here at the moment. Pick some things that you're really interested in. And then lastly, of course, you can just talk to us if you'd like. Sometimes people just want to have a back and forth conversation. You can do that, by going to our website. Book an appointment button is up on the top. Link for the websites here on the channel. Set up a 30-minute time with, Ethan and I to phone, video, in office, whatever, works best for you. So look forward to being able to, help anybody with these areas. One of the cornerstones of our concept and our practice is education. We've been doing this videos for a long time. And so I want to start off today with a summary of what I saw happening with the market this week. And so I'll switch to our kind of our weekly data, S&P 500 look going back to, 2018 here. You can see, the recent time frame here is down quite a bit.
Yeah.
As a matter of fact, we've had a 10% downturn, which they call a correction. Bear market is 20% or more. A correction is 10% or more. And this is the fifth fastest in terms of number of days to drop 10% in the last 75 years. So it's pretty unusual. And so I want to deviate a little bit from how I normally approach this and just talk about kind of, what I see, kind of what the little voice in my head says about what's happening right now. And I think this is super important because we all have this, we get this fear going on. The news kind of really ratchets around that fear. And then we start to react to that and we start to think that we know where the market might go because of what we're hearing. Okay. And I think that's one of the main things we try to push through on this channel is how to become a better investor. And one of the ways to become a better investor, first of all, have a plan. We'll discuss what our plan is and how we work through our plan of how you handle things. But secondly, get off the train of trying to project where things are going to go. All right, historically, there are a few people historically that have been decent at making some projections. But most of the times you stay in the markets and kind of hang in there, or at worst you react to what the market is telling you, okay? And so I think what's happening right now, I have a lot of conversations with clients, and a lot of them are trying to make projections about what's going to happen, and we don't know, okay?
Yep.
However, let's just talk about like what's the little voice in my head saying, okay? When first of all, last year we had 57 all-time highs, okay? This year we had, I think, 2 or 3, I can't remember the exact number, all-time highs that we also hit. But that was before they really kicked in with the tariffs, with the Doge issues, with the federal government and what have you. And now we have the fifth fastest 10% downturn in the last 75 years. Okay, so I don't know what was wrong with what was happening before. Best case scenario here is they're actually right. And we need to downsize the government. We need to downsize the amount of money being spent by the government on all these different programs. We need to, use these tariffs to kind of even the playing field across the board. And those are going to create revenues, and we can use those revenues for different things like potentially tax cuts and those types of things. But the little voice in my head says even if it does work, it's a ways off. There's quite a bit of potential pain in there. And both Musk and Trump have acknowledged that this is a transitionary period, or could be a painful period. Even the Treasury Secretary, Bassett, I believe his name is. Anyway, he's talking about, hey, we got to detox the economy and these types of things. All of these things mean that we're going to go through this period of time that could be rough, right? However, I guess the problem I'm having with figuring out how it's going to be right has to do with a couple different areas, specifically tariffs. So if you put up big tariffs, theoretically that brings in revenue to the country. But if there's reciprocal tariffs, all of a sudden basically you'll have American manufacturers, service providers that are having trouble selling their goods outside the U.S.
Yeah, they can only sell the U.S. market where they are on an even playing field.
Right, exactly. So now we're looking at, if I'm a service provider or a manufacturer or what have you, I'm looking at the situation where I'm selling to Americans. Okay, well, because of the chaotic nature of the way this has gone, I mean, just for example, I mean, we've got just sweeping, cuts of employees across the federal government without, more like a sledgehammer instead of a scalpel. And I know, like during the Clinton administration, there was about 400,000 layoffs and what have you. We had our first surplus, maybe our last surplus, actually, not first surplus, last surplus, in that time frame. But it was a bit more surgical in terms of what they were doing.
Yeah, they did it over an 8-year time period. They weren't trying to take it out very quickly. They were very methodical.
Yeah, to wipe out people that are on probationary basis, even if some of those people have been with the government for a long time, it's two problems there. Number one, been there for a long time, maybe that was because you were good at what you were doing and you got a promotion and now you're on a probationary period with that new position. Or even the other side, new people are the ones that know about AI or, the new things that are coming in sometimes, right? Mm-hmm. Okay, so, I mean, another example that I just saw the other day, which I thought was fascinating, the national parks total budget is $3.6 billion, right? The revenue that comes in from national parks is $55 billion. So it's a moneymaker. And so you cut $1 billion out of that budget and knocked it down to $2.6 billion. How much revenue you're going to lose? Because the news is all about how bad the lines are. How many people don't go to the national parks? If it's equal 1-to-1 for every billion, you'd lose $15 billion in revenue. So that's what I'm talking about. So that's what's kind of creating the situation where the consumer, the CEOs, the small business, if you look at all of the surveys of all three of those areas, all of them are saying the same things. They're worried about what's happening, and they're looking at potentially cutting back. Now, we haven't seen the data come through from that, other than a few things. We've seen, airlines are reporting that there's less, bookings that are going on. So, people are saying, hey, maybe I don't travel in this environment because I'm not sure what's going to happen and those types of things. So that uncertainty is sitting there. And so if you're forced to only sell majority of your products to U.S. consumers, and U.S. consumers are in a mood of, possible recession or even in a recession, and unemployment is going up, so less people have money to spend. It's one of the authors I read had a pretty interesting analogy. It's basically like trying to pole vault with after putting sandbags on your feet, and so it's interesting. That's what the little voice in my head that's talking to me about, kind of what's going on and how this could play out and such. There's some potential positive things that could come here at some point in time. We mentioned this back in December when we brought this up, was that you can do a lot of things very quickly, all of which the market would see as bad. Mm-hmm. So mass deportations, market sees that as bad because our labor market is already tight. Immigrants do jobs that Americans don't want to do, and they spend money and stimulate the economy with some of their money. So you take away that, and it's 8% of our workforce right now. That wouldn't be considered a good thing. The market's not going to look at that as a good thing. And then tariffs are not looked at as a good thing at this point in time. I mean, the last time we did tariffs, market dropped 19.6%, right? So again, and then downsizing the government and laying off a lot of people in terms of the contracts that are being paid out and what have you, that's potentially recessionary. So all those things are bad. You could do those fairly quickly. The one thing, that maybe the two things, deregulation and the potential tax cuts, are the positive things. But the tax cuts are problematic. First of all, you have a very thin majority in the Congress to get those tax cuts through. which usually means they get watered down in some form or fashion. We'll see how that works out. But right now, if you look at what the House has proposed, it's a $4.5 trillion tax cut. And actually, all that really is, for the most part, if you look at it, is a continuation of our current tax code that is supposed to sunset at the end of this year. And that's 4.5 trillion over 10 years. And so the way the reconciliation process works, in order to get this through the Senate without getting 60 votes and only getting a majority, which they have, you have to do this reconciliation project where they look at what the tax revenue cuts are going to cost the government over a 10-year period, and then you have to come up with equal savings.
You have to balance it.
You have to balance it out. Honestly, when I look at that, it doesn't work that well because basically everybody fudges everything. I mean, the 2017 was supposed to be balanced. It was an immediate deficit that we've never gotten out of. It's only grown because the revenues aren't, as high. The cuts aren't as high as expected, and the revenue decrease is more than expected, right? So, because I've actually seen some of the think tanks that are, supposedly nonpartisan, say there's more like 5.9 trillion to cut, to keep the tax code going we have now. However, in my opinion, we have to keep the tax code that we have now going because if we don't, it's an average of a 22% increase in taxes.
Yeah, it's very onerous.
Yeah, the standard deduction goes from 24,000 back down to 12. All of these different pieces that were in there, are come back, which would be problematic and I think detrimental to the stock market. But there's still talk about doing Social Security cuts in terms of no tax on Social Security, no tax on tips, no tax on overtime. Those aren't even included in there. There's no corporate tax included in there. And they're having trouble finding $4.5 trillion worth of cuts, even for what they have in there at the moment. It almost certainly means some cuts to some programs that people really care about, like Medicaid and those types of things. So that's going to be a ways off. It's going to take time for that to happen. And then we have to see if the market actually responds positively to that or not, especially the bond market, right? Because the bond market is the one that has to make up the difference in the deficit. If it is increased, they have to issue more bonds. And when you have more supply coming in, and if the demand stays the same, you end up with, bond market prices that are falling. So these are the things that are going on, right, in my head and how I look at this. And again, I don't try to assume I know where things are going to go because there's too many things that can change. I mean, if you look back at the 2018 tariff situation, the market dropped 19.6%. They stopped doing tariffs. They were raising rates at the same time, so it was a kind of a double whammy. They stopped raising rates and actually started lowering rates. At the moment, we kind of have the same thing, right? We're not raising rates, but effectively we're keeping them the same when we might be lowering them. If you look at the Fed minutes, they're talking about the tariffs and waiting to see what's going to happen there before they want to lower rates. I think they might have missed the ball here because we're starting to see slowdown in enough areas. If you get a lot of people thinking we're going to have a recession, we're probably going to have a recession. It's kind of self-fulfilling because people pull back the purse strings and, stop spending as much as they were when they were more confident, like they were last year. So those are the pieces. So what do you do, right? How do you combat that? Do you run for the hills? Do you go off into T-bills right away? I'd say no, mainly because most projections, most fears, most situations are wrong. And this situation is manufactured, right? It can turn into something that's not so manufactured, like we saw in 2008. But this at the moment is manufactured. They could reverse things around. Now, I'm not positive. I'm not even remotely positive that they're going to turn around on the tariffs. It seems like that's something they really believe in and want to try out. But if you look back at 2018, all of that downturn came back in 4 months, 5 months, right?
Yep.
Total waste of time. The market was dead wrong, right? Because we still have those tariffs. We just hit 3 weeks ago an all-time high. So how much impact did tariffs actually have? Now, these are bigger tariffs and a lot more in different countries. Those were just on China, originally. And so how much impact does it actually have? We'll have to see. And that's why you kind of need to wait. So what do you do? Well, the first thing you try to do, okay, so here's the step-by-step methodology. Try to lose less, for starters. Try to stay in the market, but lose less. Find things that on a relative basis are doing better than the market. Some of them might be losing less. Some of them might be actually making money. So I got a chart of things that we are looking at here, and I apologize for this. I'll try to step you through this real quickly because it's very hard to see. But the one that is touching Eason's head there, that's VTI. Okay, so VTI is the Vanguard, total stock market index, right? That's majority, I think 4,800 stocks, majority of the stocks in the U.S. stock market. Last month, it's down 8.4%, okay, as of, just half hour ago. Now, the next one up, the red one, is VT, okay? So this is one of the things that we're doing is we're rotating out of the U.S.-only core type pieces into U.S. and international core type pieces. So VT is the Vanguard Total World Index. This has 8,000 plus stocks from 47 different countries. Really, really broad. Now, that's down 4.9%, okay? That's actually a big deal. It's not great to lose money, but what happens there is you're still in the market. If things turn around, and you can actually see right now, today, everything's up, right?
Yep.
Because the S&P's up almost 2% as the show started here, and VT's up also roughly the same amount. And so the advantage of kind of staying in the market is if things turn around very quickly, you can still participate, okay? If you go out into T-bills or CDs or money markets or cash out, and the market jumps like it did in 2023 in November. It went up 8.9% after dropping 10% in a very short period of time. Matter of fact, it jumped 5% in like 5 days. So you're going to miss some of that if you're out, okay? So you kind of want to stay in with different things. So let's look at other things that relative basis. The next one is this green one. It's XLP, which is consumer staples from Spider Consumer Staples, right? That's down 1.4%. So the thought process that people still need food, they still need cereal, toilet paper, even in a recession, even when things go down, staples overperform, right? As far as that goes. The next one up is utilities, XLU. This is a Spider utility ETF. Again, people still need power. We still, even in the pandemic and all, we still need power. And so utilities are down 0.77%. Next one on there is energy. Okay, again, energy can be kind of weird in the terms of how it works during a recession or what have you. We don't use it a lot, but it is up. It's down only 0.4%. XLV, which is the healthcare, right? So that is the Spider Healthcare ETF. The Spider basically just looks at what's on the S&P 500 and kind of divides it into pieces. People still need healthcare. In the pandemic, that wasn't true. We had a recession, and healthcare did really poorly because nobody could go.
No one wanted to do any elective procedures.
Right,
So that's
exactly.
where a lot of healthcare makes money.
That's right. That's not true here. And so theoretically, if you need an elective procedure or if you have a heart attack or you have to go to emergency room, they still make some money, right, in the downturn. So those are considered defensive plays. The next one up is the orange one. You can kind of see that's a straight line. That's BIL, B-I-L, and that's an iShares T-bill ETF.
So basically short-term treasuries.
Very short-term. It's actually 1 to 3 month. Right. So you can see it doesn't fluctuate. Look at that. This straight line, just slightly up 0.3%. Okay, so that's where you might want to end up eventually. Okay, but when you're down only 10% so far, no matter what the little voice in your head is saying, I would caution you from jumping into that area, because the one problem with that area is when things take off, all of these other areas will probably go up. I would predict that almost all of them will underperform VTI. Okay, because the money's going to run back into these U.S. stocks, but you'll still outperform in almost every case, in my opinion, the T-bills. Okay, so you really want to be in the T-bills as an extreme measure in case the market's dropping 50% or something like that, like in 2008. But I put it in there so you can see how it works. And then long-term treasuries, okay? So during the pandemic, during every big downturn, long-term treasuries go up because there's a run to safety, right? Recessions are coming. There might be lowering of rates. The longer term you go out on the treasuries, the more they move up. So that's actually up 1.57%, okay? The next area is HDV, which is a high dividend paying stock ETF. In the last month, it's up 1.87%. Okay, so think about that. If you got a high dividend, let's say 5% or something along those lines that you're getting, you can drop 5% in price and break even. So it's seen as sort of a hedge, and you'll see those do outperform. Again, none of these will probably outperform when we get that snapback, shoot up, motion, right? But you'll still outperform T-bills.
So the
or
goal
money
is
markets
to
or
minimize
CDs.
downsides while still getting a shot at upside.
That's exactly it. And so at this point, that's where you need to be, okay? Not panicking, not moving to T-bills. lose less. Sometimes you're making some money. Okay, the very last one here is Europe. All right, up VGK, which is the Vanguard Europe, up 3.02%, 0.9%. Sorry. Okay, so move your portfolio towards these types of things when you start to get into that kind of correction territory. Again, the last correction we had was July through October of 2023. Market dropped 10%. Again, November of 2023, the market was up 8.9%. So you need to kind of hang in there to see what's going to happen. This is a manufactured downturn, could turn into a systematic, actual downturn that creates economic, problems. It's heading that direction, in my opinion, but it doesn't have to go there. They can change the process that they're doing here at any point in time. And so that's important. So then the last part is, how do you, okay, we believe this, let's say, we've moved into things that have a relative strength versus the market. We are trying to get ready for a rebound, but we're worried that there might not be a rebound. Mm-hmm. Okay. How do you get there? How do you stay there? And that's the other key component of what we've been talking about for the last 5 years here, is just be positive. Focus on some of the positive things. The news, I'm going to show you some things. I bet you don't see this very often in the news. It's all out there. You have to hunt for it. The news focuses on the negative. I've said this a lot of times. Mm-hmm. So this what feeds your voice, because your voice is we are all, children of the survivors that focused on the negative. They avoided getting killed by the tiger, okay? And so we have this, lizard brain portion that is sitting there telling us, be cautious, be cautious, be cautious, all right? Even when we're no longer really in need of that as much as we used to, okay? Still there, still need it, but not as much as we used to. As an investor, I think it's the number one thing that can kill you. If you look at the long-term studies from Fidelity, they show that the average individual investor makes an average of 2.1% a year over the long term. That's less than inflation. Mm-hmm. The average individual investor is a horrible investor, right? With the stock market making 10.8%, the bond market making 5.5% long term, and the individual investors making 2.1%, is because they're having a hard time overriding the lizard brain. And so when things start to fall, they panic and get out, and they move into T-bills and CDs and money markets too early, and they don't allow that chance for something to come back. And then they tend to kind of really only get interested when things look really safe, which means that they've already run a lot.
Yeah, and one of the sayings that I was always taught in college for investing was, bears and bulls will always be fine, but pigs will always be led to slaughter.
Yes.
So, like, if you get greedy or fearful, you
Right.
tend to have problems.
Exactly. And so let's look at some of the positive things that are out there. Okay, first of all, seasonality. Take the Chiron off there, Ryan, just for a second so we can see the bottom. Okay, so we've actually presented this chart last year too, heading into November. The two best months of the year, and they're tied for first. 80% of the time they're up, all right, going back to 2004. April and November. Mm-hmm. It is the 14th of March. We were heading into a very positive cash flow scenario for the market. Probably almost no matter what happens, we're going to see money coming into IRAs and Roth IRAs and those types of things. There tends to be a focus on money. There'd be some people that want to come in and dip buy. Mm-hmm. So there is a seasonality that's helping here, potentially. And sometimes, I saw an article written by Goldman Sachs yesterday actually talking about that a majority of the sales that are coming through from the market right now are from what are called quant funds. Mm-hmm. Okay, so these are computerized trading funds that basically operate on an algorithm. There's not, there's a humans developing the algorithm, but then the computer's allowed to just trade away. And so a vast majority of this downturn has been caused by these quant funds. That's bad in a way, but it's also good because they can switch around on their algorithm and pour that money back in a very fast pace, which is how you get an 8.9% November, mm-hmm. right? So again, that's sitting there. Focus on some of the positive things that are out there. Number two here, look at the history. This is going back to 1929, all right? There's been 56 10% drops or more, all right? And of those of those 56, only 22 of them actually turned into 20% drops or more, what's called a bear market. Okay, so basically 67% of the time it doesn't turn into 20%. Now, I'll admit that data doesn't include Trump doing the biggest tariffs we've seen since the Great Depression, right? So, but nonetheless, it's still something to consider. It's not that common, okay, for a 10% downturn to turn into something, 20 or more, okay? Next, I showed this last week. I still think it's super important. This is the American Association of Individual Investors. This is from the last week of February. The survey said that 60.2% of individual investors felt that the market would be lower in the next 6 months. So that seems like a bad thing, okay? But that's only happened 4 or 5 times, right, since 1987 when they started this. And look at where they were. All really good, including the one that just happened in the past. Really good buy times.
Yeah.
I mean, if you look at the 2022 one, that came just a couple weeks before the bottom hit. Okay, so contrarian investing means that when everybody's on one side of the boat, the other side tends to win just because they're out. And it allows that other piece that are still bullish, that still think the market could be good, the dip buyers, whoever it is, to come in and actually have more outsized control of the market than they would normally. And so again, we've just had that. And then there's another one here. And this is what's called the RSI index. Okay, so here's the S&P 500 is the chart. Across the purple band here is the RSI index. So this is an index that basically shows how much the market is stretched one way or another. So when it's in that band, it's not that useful, to be honest. When it gets above that or below that band, especially below, it's even more accurate. So when it gets stretched way down below 30 or maybe even 32 or below, someplace in that neighborhood, I picked all those out going back here to the middle of 2023. Look at those points. Those are all really good buy points, right? Every time it stretched down, not all of them were perfect, but really good. We just got one this week, right? Market's up 2% today. Right? Now, part of that's probably attributed to the fact that, we might not have a government shutdown. That was a bit, nerve-wracking to the market. Although you and I have done several presentations on government shutdowns over the years. The market doesn't care that much. Matter of fact, the average rate of return during shutdown was actually positive. Not by a lot. I think it was 0.1% or something like that. But I actually think that more of this is attributable to the fact that the market has stretched down so much that people are coming back in and seeing some buying opportunities. Now, you can get, things that continue to go down and down. We've seen the stretch index, like in the 2018 downturn. We looked at that today, where essentially you've got a scenario where the tariffs were coming. There were 3 times that it went below 30. The last one was the perfect one. The other 2 were actually somewhat false. And so if you're going to buy based on this, do so with part of your money.
Yeah, don't invest everything into the buy. Do a portion.
Because we've been asked that too. Is this a buying opportunity? Yes, it is. If you have a long-term outlook, it is. Now, you might have a better one coming up and a better one than that coming up. Depending on what happens, just keep buying when the RSI gets over 30 or below 30. Sorry, and historically, that works. Now, we don't do that here because it's a bit too aggressive for our clientele. Our average client is older, so we want to, be a little bit more, on the cautious side, so we're not continuously getting in there. So we're going to rotate into things that are doing better, during downturns, and then eventually we will rotate as our list shows. We will move into T-bills if we need to, as things to continue to deteriorate. If T-bills are the things that are outperforming everything, and you can see from that chart I showed, they're not. Right, even in the last month. So there are other opportunities still better than T-bills. That can change. In 2028, that changed. Eventually, that was all you had left. Money markets, CDs, and T-bills. Okay, that's when you probably need to consider some of these. One of the big problems that we see within our practice is we have clients who have big gains in their taxable accounts. Very difficult. What are you going to do? You got this huge gain in the S&P 500, and even if your algorithm or your list says, hey, you should be in T-bills, man, you're going to take a huge knock to get in there. You better be right by a lot. Otherwise, you're going to actually lose money. So very easy to do this inside of IRAs, 401ks, and those types of things, and maybe have a different strategy, or at least a much slower strategy on your taxable accounts. I don't advocate taking big taxes unless it's a situation where it really is needed. Okay, last but not least, the consumer lost in all of this data this week was a pretty important print, which came from the consumer price index. Now, consumer price index is not the index that the Fed looks at, right? They're looking at PCE, personal consumption expenditure index, but it was lower than expected. It was supposed to be at 3% on the top line. It was at 2.82%, and so inflation. One of the issues that could happen here is because so many people are worried about things, both individuals, CEOs, and small businesses, you're going to see maybe less spending. That could automatically kind of create a situation where inflation is not the big problem. Mm-hmm. And the Federal Reserve could see that and start to feel comfortable about lowering rates, which might help the situation too. So these are all things, if you're lowering rates and you've got a big stretch to the downside and it's coming up on April, factor those into the overall panic of what you see, that little voice in your head. I have one too, that is talking about, these things and how this might work out. First of all, we don't know. I mean, 2018, we were really worried about those tariffs. It turned out we shouldn't have been, right? I don't know, right? We don't know. It depends on who absorbs those costs, how that works. Some of these companies that are absorbing these are not public, so it doesn't affect the market per se, or they end up with being too small to really be a big impact. The issue is that you get enough of those in total, you have a recession, the Microsoft, Amazons, the big companies are impacted. They just are because, things slow down all the way across the board, but could have the Fed lowering rates. So that's my point. Bottom line, you got a little voice in your head that's probably yelling at you right now, like all of us do, because this is really different, very chaotic. There's nothing in this that makes you feel good about things potentially. It could work out great. It could be that this is what the country needs to avoid that collapse some point in the future, right? And there would be some pain to get through that. Maybe it's better to have some of that pain now instead of this massive, depression or whatever that might be in the future. And that's what they're talking about. That's what they're trying to do. It would be great if it was more systematic. Hey, let's use a scalpel to cut down the size of the government instead of a sledgehammer. And let's communicate directly how we're going to do these tariffs. And more importantly, what's the payoff? Okay, so if there's tariffs, what's the payoff? Where does that money go, right? How is that going to be used? Those types of things. So that's not as clear to me as it needs to be, but the market's only down 10%. This happens every 1 to 2 years. It happened just, 18 months ago? That's not a big deal, all right? It's only a big deal because of the backdrop of what's going on behind that downturn, and that's making the voices much louder in our heads. And so, however, it doesn't change the investment philosophy. At a 10% downturn, that's something you have to be able to get through. It's normal. And so you should have a process, and our process is to move into those things that are relatively doing better, try to lose less so you're ready and still invested in the market if it does snap back. When you get to those higher downturns, then you'll start to see more of the even more conservative things moving up to the top, including T-bill type things, whatever that might be that's out there that's somewhat equivalent to that. And that's maybe when you want to be considering some of those things. We're just not there yet. Mm-hmm. We might not get there. We might get there. We don't know. And so have a process. The advantage of being in the market still, even with more conservative things, like you said, you still get to participate on the upside.
Yeah, you may not get the peak returns, but you still get some of the returns, and that's the important part.
Yeah, exactly. All right. So let's handle one more question. We started a little bit late today, and so we'll go a little bit longer. We had some technical difficulties in terms of getting the show started, but we have one really important question that keeps coming up that we do want to speak about, at least at some length here.
So, will my Social Security benefits be cut?
Yeah, this is a question I keep getting. People are worried that their Social Security benefits will be cut, and because there's been some comments, different people, Musk has talked about it being a Ponzi scheme, needs to be fixed, and all these different things. We've talked about a lot of reducing the taxes on Social Security. The answer is that yes, your Social Security will be cut if we continue on the same path that we're on now.
Yeah, as long as nothing is done, Social Security will run out of money.
No matter who's in charge, no matter who's saying what, The answer is yes. And so we actually have a little countdown clock here we share with you. All right. So this is a countdown clock. It says the trust fund, the Social Security Trust Fund, will be out of money in 2035, sorry.
Yep.
And the projected deficit cut is 17%. Now, what's interesting about that, first of all, that's a big number. That would hurt a lot of people that are getting Social Security. You know, the average 65-year-old in the country has $49,000 plus Social Security. Mm-hmm. So I don't have the resources to make up for a 17% cut. And this is, everybody knows about this. We've been talking about this forever, right? And so, unfortunately, we're not talking about like how to fix this, which would make people feel a lot more comfortable. I do not feel that people that are qualified for Social Security, they're 62 or older, whether they're getting Social Security or not, will have any significant impact based on what they're doing in Washington. Okay? They will have a significant impact if we don't do something with Social Security, no matter what they do in Washington, if they don't deal with this. And so look, clock down, 9 years, 10 months, 17 days. This is the countdown. So we got a little time to fix this. But I think that's the better question is how do we fix this? Not so much are they going to cut my Social Security, because I really don't believe they will. The party in power that cuts Social Security for people that are currently qualified for it or getting it is never going to be a party that survives many elections thereafter, in my opinion. So it's a total suicide. Now, unfortunately, if you take away the taxes on Social Security, which is one of the proposals, although it is interesting to me that is not part of the House budget plan, is cutting the taxes on Social Security. Most of that budget plan is, at the moment, $4.5 trillion over 10 years, is just extending our current tax brackets and situation as far as that goes. Tax code, I guess you could call it, for personal taxes. Corporate taxes weren't going to sunset anyway, right? They went from 35 to 21%. They'll stay there unless they change it. But so I guess the better question is, are they going to cut it? Yes, if nothing happens. What could they do to not cut it?
Yeah, because essentially Social Security is funded by your taxes, your Social Security taxes. And it's just kind of a system where the government's not actually paying the bill in theory. It's all the money that goes in from your Social Security tax is paid out or put into the trust to be paid out.
Right.
And so when it goes insolvent, essentially whatever is coming in is going to be paid out immediately.
Yeah, so there's been an excess amount of money coming in versus what's been going out for forever, really. And the problem is in 2035, that stops.
Yeah, it's basically the changing of the demographics.
Right. Now, the real problem is if you stop doing taxation on Social Security, that number drops back. I've seen projections 2029 to 2030. Okay, that's not far. 4 or 5 years from now, we're looking at cuts in Social Security if you don't do anything but cut the taxes on Social Security. So I don't think they should do that personally, but we'll see what happens. It's a nice campaign promise. It's not a very good concept to do in isolation. You'd have to combine it with an overall concept of how you would change Social Security. So let's talk about kind of the four big ways that Social Security could be changed that we've read a lot about and what have you. Number one, a fair amount of conversation, especially recently, about privatizing Social Security. So you would basically, your money, instead of going into this trust fund, would go into essentially a 401k, that would be, or a pension type of thing, where it'd be invested.
Yeah, but for that to be successful, I think it would have to be professionally managed. It cannot be the individual managing it themselves.
Yeah, the Fidelity report comes back to mind again. Average individual investor makes 2.1%. So if you allow Social Security recipients to trade inside of their Social Security account from the money that's going in there, I think you're looking at a disaster. Okay, so yeah, exactly. So professionally managed or even just fixed. Put it into a fixed allocation of, Vanguard Total World Market and Vanguard Total World Bond, pick a percentage, 60-40, 70-30, whatever would work. Okay, but there's other really big issues with that. First of all, I'm 60. It wouldn't make much difference to me. I wouldn't be able to build much up versus, say, a 20-year-old would work. So there has to be some age that they would choose.
Yeah, you need a long time horizon
Right.
for that to actually be
Right.
a problem.
I would say 30 is the oldest that you could possibly do that and switch over. So it still means between 30 and 62, that whole group still has to be on the existing system, right? So how do you do both? How do you pay out all those people and all the money that's going out right now? Well, this other group is no longer paying in. They're now paying into this kind of pension system.
Yeah.
That's probably a massive shortfall in total. And that shortfall would just continue to be there for the next 30 some odd years. So the total cost to do that would be astronomical. Where does that money come from? How do you switch over? And so, yeah, again, maybe some of these things, maybe that comes from tariffs, maybe it comes from savings in other parts of the government. But that's a question that is very difficult to answer. And every time this has come up, it's been knocked down mainly by that question. That and the fact that people are worried about the stock market's ability to really long term. You get into the next Great Depression, and all of a sudden, where people really might need their Social Security, and you're talking about a 15 to 20 year recovery time.
Yeah.
It's going to be brutal as far as that goes. So we'll put that one aside for a minute. The other big ones are the reducing the cost of living increase in some form or fashion, increasing the age for retirement. Right now, full retirement is 67, and then increasing the cap. Right now, the cap's 176,000. So for those people who make over 176,000, they no longer pay Social Security tax above that 176,000. That's what they call the cap. And so there's been all kinds of conversations, but I think if you increase the cap a little bit, you make the age older. And one of the things that we were talking about today is basically you index the age.
Yeah, so they have like a longevity index. So the idea is like, if you're expected, you want to keep the gap between your expected life and the full retirement age the same.
Right.
So whatever that gap is, if it's 12 years, you expect everyone to live 12 years, so you will have a 12-year gap. And then so they were projecting that every 2 years you'd have a month further for your full
Right.
retirement.
So if it's 67 right now for full retirement age, 2 years from now it'd be 67 in 1 month. 4 years from now it'd be 67 and
2 months.
2 months and 67 in 4 months, etc. So that seems wise. If the life expectancy continues to grow, that's the problem we have right now. I remember reading in the 1980s that the average Social Security recipient only got 14 checks. Okay, so that works great, right? I mean, you put all this money in, you get 14 months worth of payments, and you're out of business. Matter of fact, when they put Social Security in, the average life expectancy was actually less than 65 when it came in 1939. So it was basically just a tax. You weren't getting anything back on average. But now the average life expectancy has moved back. With some breakthroughs in medical technology, boy, you could really have a problem. So you continue to kind of index it to that average life expectancy, so that it's covering this gap of time between that full retirement age and the average life expectancy, and it kind of stays consistent.
Yeah, and the idea is that on average, some people will die early and other people will die.
Yep.
But you only have to provide a certain amount of time for
Right.
everybody.
Right. So, and then the last thing is dealing with the COLA, the cost of living increase. They've already done that. They created a different pool of money for seniors, so to speak, that they look at for that. I would think that it wouldn't be a bad idea to kind of make that means tested. So if you make a lot of money, you get less of the COLA. If you don't make much money, you get the full COLA, and some spread in between that as far as that goes. If you had a lot of money and you got a bunch of money saved, you don't need potentially, you'd like it, you deserve it, you paid in a lot, but nonetheless, in the overall scheme of things, you have the capabilities of keeping up with inflation with outside assets potentially, versus if you don't have any outside assets like the average American 65-year-olds, that COLA is super important. So that would be one of the ways. So you increase the cap a little bit, index the age, and then have the COLA be means tested, right?
Yeah.
So there's a whole bunch of different ways that it can be saved. I wish they were talking about that more and what's going on, instead of, hey, it's a Ponzi scheme, or, hey, it's going to take some cuts and things like that.
It's not a Ponzi scheme in the sense that
Right.
everyone's paid in for so many years,
Right.
and they deserve a return for what they put in.
That's right. Exactly right. Yeah, it's not like, yeah, I agree wholeheartedly. So anyway, that's a long answer to the question of, are they going to cut my Social Security? I don't think so politically right now that's going to happen, but it is going to happen if they don't do anything, just because the trust fund's going to go back down to zero. And I will say that 17% to 20% number I've seen kicked around a long time. The Social Security Trust puts out a report every year on this. They can actually maintain that lower level of, according to their, their projections, that lower level payment for the next 75 years. So, again, that's not, it's not a good cut. It would be tough for most people, but it also could stay there for a long time too. So, anyway, we'll see how this plays out. But good questions. All right, good. A little behind schedule, but that's pretty much exactly on line with how much late we started today. I want to thank you for joining us today. We basically just covered two things. What was happening in the market. We're getting emails left and right. People are worried. I'm trying to describe, what you need to think about here, at least in our opinions. One of the big things we talk about here is how to become a better investor. And so have a plan, and then, focus on that plan and focus on some of the positive things that are happening to kind of get you through these tough times, because there are positive things happening, And then, of course, we wanted to talk about Social Security, which is another one we're getting a lot of questions about. So these are hot button areas right now. And this is just, this is what we do. We're not perfect. We don't know everything, but, been doing this for a long time. So anyway, that's our show for today. Again, if you want to send in new questions, something we talked about today, you want more clarification on whatever it is, send it in during the week here. Ask Tom at talkmoneywithtom.com. Or obviously, if you want to continue your education, subscribe to our channel. It's free. We don't make anything off this channel. We do this for free ourselves too. And so you can hit the the subscribe button and then the little bell if you want to get notified when we put out new content. And then lastly, of course, if you'd like to just talk to us, whether you're a client or a non-client, we'd be happy to talk to you. Our book appointment button is at the top of our website, and you can set up a time to meet with Ethan and I. So I want to thank everybody so much for coming today. Really enjoy the people that are, the feedback we get on this show as a whole, and look forward to being here again next week. Thank you.